It's not bad luck. It's not coincidence. And no, the market isn't randomly picking on you. What you're experiencing is a system designed to do exactly that. You spot what looks like a flawless setup. Everything lines up. You go long with confidence, you place what feels like a safe stop loss just below support, and then it happens. Price dips with surgical precision, taps your stop almost to the exact dollar, kicks you out, and then instantly explodes in your original direction without you. It feels personal. It feels targeted, like the market saw your trade and went straight for it. And here's the uncomfortable truth. You're not imagining it, but it's also not what you think. This isn't paranoia. This isn't just bad timing. There's a deeper mechanic at play here, and once you see it, you won't be able to unsee it. In the next few minutes, you're going to understand why crypto behaves like a relentless liquidity-seeking machine, how your stop-loss quietly turns into fuel for bigger players, and, most importantly, how you can stop being the one constantly getting hunted. Stay locked in, because toward the end, we'll break down exactly how to adapt your stops and position sizing so you stop playing defense and start playing smart. Most traders believe price moves because of news, fundamentals, or hype, and on a higher level, that's true. But zoom in, trade by trade, moment by moment, and something much more mechanical is in control. The market, at its core, runs on order matching and liquidity. That's the engine. That's what actually moves price in the short term. So what is liquidity really? It's simple. It's about how easily a large position can be bought or sold without dramatically shifting price. If you're buying a small amount of Bitcoin, no problem. There are plenty of sellers. You get filled instantly, smooth. But now imagine a whale stepping in, trying to buy a massive position. Suddenly, it's not so easy. If they slam a huge market order, they push price up against themselves and get terrible entries. Slippage eats them alive. So they think differently. They don't ask, where is the best price? They ask, where is everyone else forced to act? And this is the core shift you need to make, because in reality, price doesn't move toward fair value. Price moves toward liquidity. Wherever there's a cluster of orders waiting to be triggered, that's where price is drawn, like a magnet. Now, let's bring this closer to you, your stop loss. To you, it feels like protection, a safety net. If price gets here, I'm out. Risk controlled, I'm safe. But from the market's perspective, especially from larger players, your stop is something entirely different. Your stop is a commitment, a future action waiting to be triggered. If you're long, your stop becomes a future market sell order. If you're short, your stop becomes a future market buy order. And here's the catch. While the order book shows visible limit orders, your stop and thousands of others remain hidden, invisible, sitting beneath the surface like landmines. And the moment price touches that level, they all detonate into market orders at once. Now think about how most traders are taught. Place your stop just below support if you're long, just above resistance if you're short. Use clean, round numbers. Sounds structured, sounds disciplined, but what does that actually create? Massive clusters, pools of stop losses stacked in the same areas. To you, that feels like smart risk management. To a whale, that looks like a buffet, a concentrated pool of liquidity just waiting to be consumed. So who's actually behind these stop hunts? It's not some villain staring at your individual trade. It's a network of participants with the same objective. Whales managing huge capital, market makers constantly balancing bids and asks, algorithmic systems scanning for liquidity patterns. They all face the same constraint, size. They can't just enter positions aggressively without moving the market against themselves. So instead, they hunt efficiency. And the most efficient liquidity is forced. It's where traders have no choice but to act. Stop losses, liquidations, that's where the real opportunity lies for them. If a big player pushes price into a zone packed with long stop losses, those traders are forced to sell. Their stops convert into market sell orders, providing exactly the liquidity the big player needs to buy. The same logic applies above resistance for short positions. This is why stop hunting isn't just manipulation, it's strategy. It's how large players operate in a market driven by liquidity.
Let's walk through a clean example so you can actually visualize this. Imagine Bitcoin is trading at $50,000. There's an obvious support level around 49,500, clear on every chart. Retail traders start going long above it, and their stops, predictable, 49,400, 49,300, 49,200, just below support. From a liquidity perspective, that whole zone below 49,500 becomes a dense pocket of stop losses, a liquidity hotspot.
Now imagine a whale wants to build a large, long position. Buying heavily at 50,000 isn't ideal. It drives price up. So they look lower. They want forced sellers. So here's how it unfolds. Step 1. They start selling aggressively. Price begins to drop. 50,000, 49,800, 49,600, approaching 49,500. Step 2. Other traders see support weakening. Some panic sell. Others flip short. Selling pressure builds. Step 3. Price dips below support into 49,400. Now the stop cluster triggers. Long positions get stopped out. Each stop becomes a market sell. Price flushes fast, 49,000, maybe even 48,800. Step 4. Down there, waiting patiently, the whale has limit buy orders sitting, absorbing all that forced selling. They're literally buying from panic. Step 5. Once that pool is drained, the forced selling disappears. Price stabilizes, then rebounds. 49,000, 49,500, back toward 50,000. On the chart, it looks like a simple wick below support, followed by a strong bounce. But if you were stopped out at the bottom, it feels like you were targeted. In reality, price just did its job. It moved into liquidity, consumed it, and moved on. This behavior exists in every market, forex, stocks, futures, but crypto amplifies it. First, it never sleeps. It's 24/7. Liquidity shifts constantly. During off hours or weekends, order books thin out, making it easier to push price into stop zones. Second, leverage is extreme. 10x, 20x, 50x, even 100x. That means liquidation levels sit dangerously close to entries. When many traders are positioned the same way, their liquidations form massive pockets just a few % away. Trigger that, and you get violent squeezes. Third, liquidity is fragmented, spread across exchanges, pairs, and altcoins with thin books. It doesn't take massive capital to create massive moves in these environments. Fourth, regulation is lighter. No circuit breakers, no halts. Price can move aggressively in seconds without protection. Put it all together, constant trading, high leverage, thin liquidity, minimal safeguards, and you get market where stop hunts aren't rare, they're normal. They're built into the system. So what now? If the market hunts liquidity, are you doomed to always be the target? Not at all, but you must evolve how you think about stops. First, stop placing your stops where everyone else does. Obvious support and resistance levels attract clusters, and clusters attract price. Instead, ask yourself, where is my trade idea actually invalid? Often, it's beyond the obvious level, maybe below a higher time frame structure. That usually means a wider stop, but a smarter one. Second, adjust your position size, not just your stop. If your stop is wider and your size stays the same, your risk increases. Professionals flip that. They define risk first, then place the stop where the idea fails, then size the position accordingly. Retail traders do the opposite. They want bigger size, so they tighten stops. In crypto, that's an invitation to get wiped. Third, consider using alerts or soft stops, especially on higher time frame trades. If you're not over-leveraged, you don't always need a hard stop sitting in the order book. Set an alert. Let price reach your level, then observe. Is this a real breakdown or just a quick liquidity grab? Then act. It takes discipline, but it avoids getting wicked out in seconds. Fourth, learn to spot liquidity sweeps.
Look for obvious highs or lows getting taken out with sharp wicks. Watch volume spikes. Notice how price snaps back into range. That's often a stop run. And instead of being the trader who got caught, you can be the one entering after the trap is sprung. So next time your stop gets hit and price instantly moves without you, don't take it personally. Don't assume the market is against you. Understand this instead. The market is doing exactly what it's built to do. It's seeking liquidity. Your edge comes from not standing where that liquidity is concentrated. If this opened your eyes even a little, hit like so more traders can see this. Subscribe if you want deeper breakdowns like this. And tell me in the comments, have you ever been stopped out right before a massive move in your favor? Because in the next video, we go even deeper. We'll look at real charts together and break down live examples of liquidity sweeps and stop hunts so you can start spotting them in real time. Until then, remember, trade with awareness, not emotion.